Okay, so this is homework 10.2. And the first thing that I want you to make sure and note, first of all, you want to use this template. You want to save the template in your portfolio just so that you have it forever, because I'm hoping that at some point in your career, you're going to need to do something like this or show that you can do something like this. And the first thing that I want you to note is that we want to have our years, our time going horizontally, sort of like a timeline. And you want to have a column for current cash flows as well as a column for each year in your analysis. And this should look similar to, how we did the budgets for a regular 1-year budget. And so the other thing I want to note, right, just like when I was teaching you how to do budgets in Management 214 in managerial accounting, is that you want to sort of as a best practice for building financial models. You always want to have your assumptions area separate from your calculated area, because you can go in and change all your assumptions. When I was first setting up this file, the numbers that I was given in yesterday's analysis that I was working with, $4.1 million, and today we are looking at $4 million, right? So you can change the numbers. This area down here, right, from line 14 on, there are no numbers being put in directly, right? So if I were going to check on a spreadsheet, right, the first thing I would do would be to go to the formula view, and if I saw anything down here that wasn't a formula, I'd kick it back to you and tell you to do it again. Okay, everything down here below should refer to the numbers up here, and then if you change the numbers up here, it'll flow through and your analysis will hold, and you will get to your rate of return on this investment. Okay, so our setup is the managers of Classic Autos Incorporated plan to manufacture classic T-Birds, 1957 replicas. The necessary foundry equipment will cost a total of $4 million and will be depreciated using a 5-year maker's depreciation schedule. The sales manager has an estimate for the sale of the Classic Thunderbirds. The annual sales volume will be as follows, and they give you how many you're planning on selling. And if the sales price is $27,000 per car, variable costs are $19,000. Fixed costs are $1.4 million annually. What is the annual operating cash flow if the tax rate is 30%? The equipment is sold for salvage for $500,000 at the end of year 5, and net working capital increases by $500,000 at the beginning of the year and is reduced back to its original level at the final year. Okay, so find the internal rate of return for the project using the incremental cash flows. So we have got to figure out the incremental cash flows, but the first thing we want to do is just put in our assumption. So in my case, our cash flow right now is going to be $4 million. I think I need one more zeros. Yep. So we're going to spend a negative $4 million for equipment right now. Our maker's data is found within this table here. And one of these days, maybe I'll show you how to, I'm not going to do it. If you're ever curious, though, I could show you how to make a table lookup function that would allow you to do makers for any kind of capital investment. So let's just put our percentage for the years. And again, these years here are laid out vertically. We want to just put them in horizontally. So we've got 20% in year 1 and 32% in year 2 and 19.2% in year 3 and 11.52% in year 4 and also in year 5. And you will notice, just as an aside, that the makers tables go out for an additional year on the assumption that you purchased the equipment halfway through the first year. So what you're looking at in year 1 is basically half of a year's depreciation, and you pick up the last half of it out here in the half a year after you're done with the product. But because we're going to sell the thing, we're going to sell the foundry equipment at the end of 5 years, then it doesn't matter that we didn't recover the whole cost for depreciation. Well, it's not relevant. Okay, so our sales volume, you know what, I should probably make this bigger for you, huh? So in the first year, we're going to sell 260 of these cars. In the second year, 280. In the third year, 320. In the fourth, 360. And then the fifth, 320 again. And the price is not going to change. It's $27,000. And the variable costs are not going to change. That's $19,000. And fixed costs are $1.4 million. Tax rate is, where is it, 30%. And the salvage value, $500,000. And then our working capital change is $600,000 at the beginning, and then we get that back at the end. All right.
Sorry, I've got to interrupt.
Actually, you know what? That's probably a good spot to stop. So I'm going to stop the recording. Actually, I'm going to end it by saying, so I want to note that we want to make sure, like I said before, and keep all our assumptions separate from the calculation area, so that if we change any of these numbers, it'll all just flow through. Okay. So let me stop the recording, and then I'll make a new one to start calculating what we need to calculate.